Well, good afternoon, everybody. In this case, Griffin, to our lunch and learn about refinancing your home and kind of understanding the factors and things that go into that. Uh, I'll introduce myself, Paul Scarfone. I have my business DollarWise. I'm a financial coach, and I'll help people just with all aspects of their financial situation. Most people aren't where they want to be with their money, and I help them create a plan and set some goals to get after it so that they can be in a better place and have a better future with their money. Griffin has been a longtime friend of mine in the mortgage industry over 15 years, and he's uh, graciously agreed to join us today to talk about mortgage refinancing and what factors go in and just how to be better prepared for that conversation so that you can be well armed to make decisions that make sense for you and your family. So welcome, Griffin.
Thanks, Paul. Happy to be here. Thank you for having me.
So first slide we're going to go to, and I'll let Griffin kind of take this one. But this is the reasons that people kind of approach Griffin when they're looking to refinance their home.
Yeah, I mean, right now rates are really low, so we're having a lot of conversations about refinancing. The major reason that we have the conversation, the starter anyway, is my rate is high, or it seems to be high relative to the market, and how do I get that lower so I can lower my monthly payment? It's really a function of just that. What's your balance in your mortgage now? What the new rate would be, and how much money is that dropping your monthly payment? With rates so low, we've had even more conversations about maybe keeping your payments the same, or maybe even able to reduce your payment and switch to a shorter term. Somebody who has got a loan like a 30-year fixed a couple of years ago, the rate can come down so much that they can switch to a 20 or a 15-year loan, pay off the loan faster, and not really have to absorb much of a payment increase because the rates are so low right now. But it's one of two things, sometimes both: lowering the monthly payment and paying off the home quicker, which over the time, the interest that you save by paying the loan off sooner is tremendous, and we'll be able to illustrate that a little bit later. Some of the other reasons that people do refinance, though, and I know Paul is with me on this, we don't necessarily recommend it, is maybe consolidating some debt or getting some money out of the home. These are things that got a lot of people in a lot of trouble 10 years or so ago, right before the first financial crisis. So it's something that people do, and there's certainly reasons why you shouldn't do it. In some cases why you should do it, but I would definitely lean on the side of something that most people wouldn't do. I think Paul would agree with me there, right, Paul?
Yeah, I definitely do. Taking stuff, especially if it's credit card debt or student loans or other things like that, that is unsecured, to then be tying up your biggest asset, with your house, it just adds a whole nother level of risk that a lot of times when we're looking at it, it's really risk that we don't want to put there. Rather, we want to come up with a plan, be on a nice budget to just get after those maybe those consumer debts or maybe student loans, and just kind of get them out of our life so that we can just free up our house as soon as we can. That I love the paying off your home quicker idea. Most people, it's hard for them to imagine what it would be like without a mortgage. I remember my years in banking, I had one client who he called it a forever mortgage. He had gotten like some 40-year mortgage from someone before '08. I don't even think they offer those anymore. And he was just like, I'll always just have a mortgage. But if you can start to think about what you'd be able to do with that monthly payment once that mortgage is gone, a lot of us want to, whether it's fund retirement or start saving for our kids, college education, it opens up your cash flow big time when your mortgage is gone. But that's my favorite reason on this list. And I know there's others, I'm sure there's others that, Griffin, you get approached with depending on someone's specific situation. And that's why we're here. We can kind of help you answer those questions as you, in your own particular situation when you're faced with them.
Right, and that's very much, it's all of these refinance scenarios are very much case by case. There's not one size fits all option when it comes to refinances, and we'll address that as we go forward here. But it is very much case by case basis. So when people are thinking about refinancing, they really need to talk to a professional to help them understand, what the benefits are, what the costs are, so they make sure that they're understanding their choices to making the right decision. It's not a one size fits all process.
So Griffin, we do run into, we were talking earlier, like refinance myths or just misunderstandings, and I'll kind of propose each one to you, and you maybe tell me, where there might be something to dispel it. But, we've heard I need to reduce my rate by at least 1% for the refinance to make sense. What do you
Yeah.
say to that?
That is the one that I hear the most. And I don't know where that came from. I've been in the business for over 15 years, but I've been hearing that one since day one. It's nice to have a 1% reduction in your interest rate. It's certainly not necessary to make the refinance make sense. It's really truly a cost versus benefit calculation. In most cases, the bigger the loan, the less of a rate reduction you need to make this worthwhile. And again, we'll illustrate these things later, but in most cases, you can get by with at least a 0.5% reduction in your interest rate to start the conversation of making sense with how much am I saving versus how much is it costing me to get this done. So the 1% is a big misnomer. I think that prevents a lot of people from even having the conversation because they see a rate of, I have a rate of 3.75 or something like that, and I need to be at 2.75 for this to make sense. Well, that is not the case. If your loan is, a couple $100,000, even more, like I said, the higher the loan, the less of a reduction you need for this really to make sense.
All right. Another one I've heard, I hear this a lot. People say I shouldn't refinance because I'm just 3 years, or maybe I'm just into my new loan and all the interest is front loaded and, I'll just be starting all over.
And in some cases, you will be starting all over. And that, again, goes into the cost analysis of this. And that's one of the things that I take my customers through is, what you've already paid certainly matters, but it's really looking forward in terms of how this loan is going to be paid moving forward. You can't just look at the monthly savings. You also have to look at the reduction of your interest over the life of the loan, whether that means you're going from 25 years left back to 30 years. In some cases, the rate reduction might be so much that not only are you saving a couple $100 a month, but you're saving tens of thousands of dollars in interest, even starting over at 30 years. And a lot of cases can be made that you just take that savings and bury it back into the loan, and you're then paying the loan off even quicker. So it does have to be considered, how long you're into a loan, because if you only have a few years left, then a lot of times a rate reduction on a refinance isn't going to make any sense. But if you're only 2 or 3 years into a loan, especially if it's a 30-year loan, a lot of times a refinance is still going to make sense, not only for the short-term benefit, for the long run too.
Awesome. Now, I for most of us, we all kind of take our past experiences and let them influence our current decisions. But I've heard people, they try to refinance before, it didn't work, I didn't qualify, and they just really don't feel like engaging in that again.
Yeah, and it is a trying process, especially if you didn't qualify for whatever reason, or you just didn't understand the process and just let it fade away. It's one of those things where the end justifies the means. And if you didn't qualify, there's a lot of different reasons that maybe you didn't qualify for, or you just didn't get somebody who was giving you the right information to run the course of the process. I will tell my customers up front whether or not I think it makes sense for them to pursue, whether it's from a credit standpoint, whether it's from a home value standpoint, whether it's from a savings standpoint. I want to make sure that they have the right understanding to do this. And a lot of the cases, they just don't get the right information. They don't get the right education to understand why they didn't qualify. In some cases, people won't qualify, but understanding why they didn't qualify is almost just as important as to why they do qualify. So it's part of the conversation that I have with my customers.
Yeah, I know a lot of times, especially if, we see it a lot with new home buyers, but maybe someone's the first time they're going to, refinance. They just don't understand the process. They feel like it's a lot of work, or it's too complicated, and that becomes their challenge to do. What do you say to someone like that?
Yeah, I mean, the process can be a little wonky. You are applying for a loan, so if you remember having to provide all the paperwork and everything that you did the first time around, you're going to have to do it again, whether you're refinancing with a new company or refinancing with the company that holds your loan now. There is a lot of paperwork and process involved, but that's my job, is to set the expectation of the process up front with my customers so they know what to expect along the way. Because it can get frustrating, if you're having multiple requests for paperwork, or you're not having good communication with your loan processor. We try to make sure that we cut through that to make the process as easy as it is. It's not an easy process, and it can be a lot of work, but that's where like I said, the end can justify the means. But, a lot of it goes into what to expect going into the process. Because if you expect a bumpy road, or if you expect, the process to be, some work and some paperwork, then you're not going to be frustrated along the way when things pop up that are needed to finish off the process.
And I would even give you a little plug here. You've refinanced for me and my wife a few times at different loans, and it is valuable having someone that's kind of walking you through the process. I know, in this time of internet and online loans and borrowing and lending, it's easy to think, oh, less human interaction. I can just kind of throw it in this portal and hopefully I'll get through it. And, I, from my own personal experience, have realized having someone that can kind of explain to me where we are, if there is some holdup somewhere or a challenge to overcome, I've got someone who's talking me through it and working with me. So it's a little shameless plug for you there, but you do a good job with that. And that's that human interaction piece that's so important. I also hear frustrations from people and they go, you know what, I'm not even going to try because every time I try that advertised rate that was out there, when we finally start talking rates, I don't seem to qualify for it.
Yeah. Yeah, and there is a lot of advertised rates, especially when rates are low and activity is high and volume is high. There's a lot of companies out there trying to entice you into applying for their loan. And whether it's a rate that's not fully disclosed, whether it's a rate that's not fully understood by the consumer, it can get frustrating when you see something, a nice shiny rate on an internet site or something like that, and you can't get it when you make the call. That is where that whole one size does not fit all when it comes to this process. There are things and costs that need to be factored in as to why that rate is being advertised. There's a lot of fine print to it. That's a part of the, customers not understanding the process. There will be some, things that you can get that rate, but you have to know how to ask the right questions. And I help people understand how to get that rate, not why they can't get that rate. So the advertised rate can be very, very confusing. APRs and points and closing costs and things like that are a lot of factors that we'll talk about that go into rates. But in some cases, what you see online is not always what you're going to get when you actually apply for the loan.
All right, perfect. Thank you. So next thing we'll get into just what are some of these factors that we'll look at when we're trying to determine if the finance is appropriate for us. First one we have on here is interest rate.
Yeah, and that's obviously the biggest key. That's what triggers most people into doing this in the first place. They see what the rate is on their statement. They see what the rate is on their website, or when they're logging in to check their mortgage, they see that rates on their bank are advertised lower. That's the first catalyst to doing this is, hey, rates are lower than what I have now. And that's the biggest component to starting this whole conversation.
And we know that you already mentioned, like, that's not the only factor, right? Just like someone saying, well, it's got to be at least 1%. 0.5% could be key. Or some people, there could be a scenario, maybe 2% doesn't make sense. And that's because of our next point here, right? What's your time expected that you're going to be in that home?
Yeah, and that's a big one. And I don't really hear a lot of people talking about it, but to me, this is almost as important, like you said, in terms of what the rate reduction is going to be, is, how long you're going to be in this home, because there are costs to be considered. There is effort to be considered in this. So if you're not going to be in the home for more than a couple of years, even if you're dropping a couple percentage points in interest rate, you're probably not going to be there long enough to really justify going through the process, whether it's from an effort standpoint or a cost standpoint or both. So, when you're having that conversation with your mortgage professional, make sure that is part of your conversation, that, hey, we're going to be here for 5 years, we're going to be here for 10 years, we're going to die in this home. There's a lot of things that can be tweaked based on what your time in the home is going to be. It's a huge factor that I don't think gets talked about enough.
And you mentioned the amount of the loan, right? Because a certain percentages of a bigger number is a bigger number than a percentage of a smaller number. So what about the amount of the loan that could impact us here?
Yeah, there's a couple of really big factors with the amount of the loan. First and foremost is, how much of a reduction based on the rate. You're going to get a bigger reduction in your payment because your rate is bigger. $200,000 loan is going to have more of a savings than $100,000 loans with a 0.5% reduction in rate. It also does factor into the type of loan that you can get. The bigger your loan, in some cases, the less your options are in terms of the type of loans that are available. You hear about jumbo loans and things like that. So in some cases, the bigger the loan, you might have less choices available. So it's something to be cognizant about when you're talking about your rate or shopping for your rate is how big is my loan and what are my options are. Sometimes that can be based on geography. Sometimes it can be based on your state or your bank or who you're working with, but your loan amount also has a lot that can factor into the types of refinances, products that are available, and also the savings on the loan itself or the payment itself.
And the final factor here is really these closing costs. And I know for most people, especially when they talk about buying a home and going to the closing, right? It's one of these mysteries, right? It's what are the closing costs going to be? How expensive is this going to be? And when you're refinancing a home, I can only imagine how important it is to understand how the closing costs impact the the refinance. So can you tell us a little bit about closing costs?
Yeah, closing costs are going to be similar to what you paid for when you purchased the home. Title insurance, appraisal fees, recording fees, stuff like that. And we have a slide that goes through some of the things that you'll run into when looking at closing costs for a refinance. And it can be prohibitive in some cases. It's not cheap to do a refinance. And generally the costs are directly associated with the rate that you can get. So people want no closing cost refinances, stuff like that. But you don't necessarily want to sacrifice the rate savings by talking exclusively about low or no closing cost refinances. Everything should be factored in. So it's a big component of it that goes into the crux of the break-even analysis that we do for our customers to make sure that they understand not only what their monthly savings is, what the costs are, how long it's going to take to break even on those costs, and that goes back to how long they're going to be in the home. That's all the calculations that we do when we're talking to our customers about whether or not this is a viable option for them.
And so, Griffin, I put up our slide here about closing costs that are involved. And, I can see between the application processing fee, the appraisal fee, the closing settlement fee, title search, title insurance fees, origination, other discount fees. And, I think for it being as big a factor in this as you're talking about, I know that these aren't the same for every loan, and they can probably be different by state, right? By the lender. And so, which ones do you think are, are areas that people really have to be careful and ask questions on?
Yeah, the one thing you want to do when you're talking to a lender about a refinance is get what's called a loan estimate or a fee sheet on the costs involved, because you can get a nice rate quote, but if you don't have a really understanding of where those fees are that are associated with that rate quote, you might be paying more than what you really need to be paying to get that rate. Application fees and processing fees these days are more lumped into what's called like an origination charge. So that's one thing that the government's done to make shopping a little bit easier is those fees are, as opposed to being itemized out, they're all in one charge called the origination fee. And that's the bank's cost of processing, closing, underwriting your loan. So that's one factor that can change a little bit from company to company. So you want to be aware of that. Appraisal fees, for the most part, it's the cost of the lender to evaluate the collateral of the home. So they want to know what the home is worth, and that's a big part of the process. And for the most part, appraisal fees are pretty similar from lender to lender in a general area. Same with closing settlement fees, mostly charged by an attorney, sometimes a title company to close the loan. They're generally in the same range. In the state of New Jersey, title insurance is a state-regulated fee, so that's the cost is the same no matter which title company you choose to use or your lender chooses to use. It's usually the biggest ticket item on the refinance. Hard to avoid, but certainly something that has to be disclosed. But that is where a lot of the fee comes in, is redoing your title insurance. So we can get to, why title insurance is important, but it is a cost that you have to factor in regardless of the transaction. Even if you have title insurance now, you're going to need new title insurance going forward. So it's a big ticket item that we have to factor in to make sure that it gets covered with your break even. Go ahead.
Yeah, I was going to say one of the things that it's just good to know. A lot of times, mortgage rates and stuff. It's easy to have, whether it's water cooler talk, which might not be happening a lot of now during COVID, or just talking to a friend and they say, "Hey, I got this rate," and you say, "What were your closing costs?" And they say it was $4,000. I mean, that closing cost, after you explain these here, it's really particular to your situation.
Yeah,
And it would be, yeah, it'd be wrong to think that, the closing costs, if it was 4,000 for one person, it's going to be 4,000 for the next person, just because of all these different factors based on loan amount, where your home's located, what type of title insurance you need, and what lender you're going with. So this is very helpful. Thank you.
Yep. No, appreciate it. Yeah. And the last thing too, just the discount fees. Those are, it's another word for points, and that's where you get a lot of the misinterpretation of the rate that you're getting is how much are you paying in additional fees to get that rate. And we'll talk about points a little bit, but usually it's a cost that you're paying extra to get a lower rate. But you want to make sure that whatever rate you're getting quoted, at least the conversation starts with no points, because then you can kind of build from there. And we'll kind of explain that in some of the scenarios that we have lined up later on.
All right, and the next slide here, we talked about as one of those myths or understanding and just not understanding the process or all the paperwork that might be involved. So can you kind of walk us through some of these paperwork requirements?
Yeah, so for about 10 years now, maybe a little bit longer, the mortgage process has been a full contact sport in terms of getting your paperwork and due diligence done by your lender. So even if you have a loan now with a bank, and you go back to your same bank to get a new loan, a refinance, and you're lowering your payment, lowering your rate, all these things, they still have to go through a full due diligence request in terms of your paperwork, because they're ultimately serving an investor who is going to identify this as a good or a bad loan. So that leads to all the paperwork that you're going to see here. It's not going to be the same for everybody, but this is a good starting point to understand, what's going to come up usually at the application to do your loan. They're going to need to verify your income. That's usually done if you pay stubs and W-2s if you're not a self-employed person. If you're a self-employed person, then we start digging into tax returns and 1099s and things like that. But they're going to want to know, that you're viable going forward, that your situation hasn't changed, that the due diligence, results in an underwriter looking at your file and saying, yeah, Paul, you can still qualify for this loan. Even though it's $300 a month cheaper than you're paying now, we have to make sure that your situation still can pay that loan going forward. And that's where most of this paperwork and underwriting and scrutiny comes into play.
Awesome. And then the last few things, which are great pieces just to have to even start the conversation, right? Your mortgage statement, understanding what the tax cost is, and those types of items do go factor into like the monthly payment aspects of it as well.
Yeah, and usually my refinance conversations start with my customers is send me your most recent statement, because that shows me everything that I need to give you the best case-by-case, apples-to-apples comparison to what you have versus where we can take you. So, most cases that mortgage statement includes your taxes and your insurance and stuff like that. But if you have association dues or if your taxes and insurance are paid separately, I want to see that information so I can show you exactly, your situation versus some of the options that we're going to be able to present to you. So that's usually where I start my conversation is, let's see your most recent statement so we can start crunching some numbers.
Awesome. So the next slide we have here, Griffin, as we were talking earlier, sometimes when we enter a realm that maybe we're not in that much, right? If you've only bought a home and never refinanced, or maybe only refinanced once, or it's been a while, sometimes mortgage loan officer or anyone in the financial world might be throwing terms around that's hard to keep up with, and we don't quite understand, and we might just want to shy away from the conversation because we just don't quite know what they're talking about. So, there's probably more terms than this. We even so far talking, one note I took down was just a jumbo loan, right? When someone hears a jumbo loan, it sounds like a big loan, but a lot of people just don't even quite know what that is. But maybe kind of tell us a little about a jumbo loan real quick, and then we'll go through this list real quick to give some basis so people know what they mean.
Yeah, sure. No, I try my best to not get into the weeds with my customers in terms of, jargon and things like that. Sometimes it can be tough because these are terms that I take for granted because I'm in this conversation every day. And I tell my customers that if it's something that you don't understand, ask me, because I want to explain it. I want to make sure you have the right understanding. But yeah, I just wrote jumbo loan, like everybody knows what that is. But without getting too technical, there are multiple buckets in which we can choose from as lenders to where to help you get your financing from. Jumbo usually refers to a loan that's too big to be guaranteed by Fannie Mae or Freddie Mac, which are the government agencies, which most of the loans are done through, banks, brokers, or otherwise. So jumbo loan, depending on your county, your state, is usually a loan that's over $510,000. And it just sometimes limits the options that are available to you in terms of how you can finance your home. The conforming loan limit is what sets that jumbo tier. The conforming loan limit across the country right now is $510,000. So if your loan is over that, in some cases you will be a jumbo loan and have to just submit to different terms or options when financing your home, whether it's a purchase or a refinance. So it's based on the conforming loan limit, and the conforming loan is set by Fannie Mae or Freddie Mac, which are government-sponsored enterprises, which dictate a lot of the financing provisions and rules and things like that, which go into mortgage. So it's a little technical, but happy to explain that because a lot of people don't understand it. But it is an important factor where you fall in terms of your loan amount.
Thank you.
Did I confuse you more, or is that okay?
Oh, no, that's very helpful. But again, another reason why I'm just thinking is you're saying there's other factors and it's a different place you have to go to find financing. That's another reason why an advertised rate might not apply to your situation.
Exactly.
If you're in a jumbo loan, it's that, the advertised rate and the little asterisk with the fine print that on like a television commercial or sometime an online commercial, there's no possible way to read all that disclosure. And it's jumbo's probably found in there a lot of times.
Yep. A lot of times if you're looking at a rate online, you have to click on another link that'll take you to the terms and conditions, and then it buries you with fine print in terms of, well, your loan must be under 510, it must be 30% equity in the home, you must have a credit score over 740, and a lot of factors go into your rate and stuff like that you can't really put on a flashy billboard or a banner ad or something like that. You really got to dig to make sure you're getting the right information. And that, like you said, that's the first one you have on your list there, APR, annual percentage rate. I get a lot of people who ask me, what the APR is, and it's a difficult question to answer offhand because in most cases, as a lender, we're looking at the note rate. The note rate is your payment rate. Your annual percentage rate is a factor that's based on that note rate plus the costs that are associated with getting that rate. So when you don't have a fee estimate or a loan estimate, an APR can tell you that, well, even though that rate says 3%, if my APR is 3.5%, I'm paying more than if my APR was 3.2% to get that same payment rate. So it can be confusing. You really want to focus on what the note rate is and what the cost is to get that note rate. So when you're getting a quote, you're getting an estimate from a lender, make sure you get a loan estimate, which is the last thing on your slide there, because that will break down your note rate, your payment rate, plus any fees associated with getting that rate. So the APR is more for advertising, really, than anything else, because if you're actually talking to somebody about getting a loan, they should be able to send you a loan estimate that'll break everything down.
And what about private mortgage insurance? I know some people pay it, some people don't, and the people that pay it don't seem to really like it very much.
Yes, private mortgage insurance allows buyers to purchase homes with less than 20% down. It's a insurance factor that is risk-based, meaning that the more money you put down, the less your premium is going to be. The higher your credit score is, the less your premium is going to be. But it is really the only facility that allows lenders to finance homes with less than 20% down. So it's a necessary thing in some cases. A lot of first-time home buyers put down 5 or 10%. Mortgage insurance is a factor that has to be considered, and what we look at a lot when it comes to refinancing is, can we eliminate that mortgage insurance because your home is worth more than it was when you bought it? Can we reduce that premium because now you have more equity in the home? So it's a factor that has to be considered when doing a refinance, but it is a necessary evil if you want to buy a home with less than 20% down.
So that's a really good point, especially for our refinance conversation here. So anyone that's paying private mortgage insurance, I'd say if they've probably been in their house for over a year, should probably have someone take a look at it, depending on how much they may have put down. Because if they've gotten equity or they've made significant payments towards their principal, dropping that PMI and maybe just applying it to the principal of their loan,
Huge. Yeah, it can be huge.
Yeah, if they can shorten their term and they're out of pocket, doesn't really change much.
Yep.
That could be a really good point.
And I will say too, that's one of the things that's gotten cheaper over the past 10 years is private mortgage insurance. 10 years ago when we were coming out of a recession, mortgage insurance was extremely high. And now it's much, much cheaper. It's a little bit more risk-based, so you're going to get a much better rate with a higher credit score than you would have a few years ago. But if you have great credit and you've had your mortgage insurance for more than a couple of years, even if you're at the same loan-to-value spread, and that's another thing that we'll address down there, you might be better off because you'll get a better premium than you did 2 or 3 years ago, just because premiums have gotten cheaper over the past few years.
So you mentioned discount points when you were talking about APR. Can you explain a little bit more what discount points are?
Yeah, so that's one thing that'll be directly correlated with that APR, right? So if my rate is 3% with no points, and somebody else's rate is 3% with 1 point, even though our note rate's the same, you're paying more to get the rate with a high APR, and that's usually a function of those discount points. I usually use them more from the context of how much lower can you buy your rate down, and does that make sense from a cost benefit standpoint? 1 point, for those who don't know, is 1% of your mortgage amount paid as a premium when you close, generally in exchange for a lower rate over the term of the loan. So 1 point, 1% of your mortgage amount, cost-wise, gets you about a 0.25% reduction in your note rate, which breaks out to usually a break-even factor of about 5 years. And so they're expensive. They take a little bit longer to pay off in terms of a break-even, but you can save a lot of money over the life of your loan if you buy those points soon in your loan financing standpoint. So something that we have broken down in a spreadsheet, we'll see in a little bit, that how that affects your payment, how that affects your term interest by buying down your rate with discount points.
I see. So if I have a $300,000 loan and I'm paying a point, that's going to be $3,000 because that's 1% of my loan amount.
Correct.
But it, in theory, could take my rate from 3.25% to 3%.
Exactly.
And then
Yeah.
that's what we'll look at on your spreadsheet. Like when we do that math, was it worth it, and how long does it take to recoup that?
Right.
Which then leads us right into our break-even analysis.
Yeah, and that's a function of how much does it cost, how much are you saving, usually expressed in terms of months, breaking even on your $3,000 worth of costs in 36 months. So that means it's taking you 3 years to recoup the costs based on the savings, and really after that 3 years is when you see the significant savings of the monthly reduction in your payment. So that's the biggest factor in terms of a refinance, in my opinion, is how long is it taking you to break even on those costs. Whether it's 1 year or 3 years or 5 years has to be factored into how long you're going to be in that home. So those two things together usually leads to whether or not a refinance makes sense for that particular customer.
Now, we spoke to loan to value and mentioned LTV a few times in discussions with the private mortgage insurance.
Yep.
What's loan to value? What are we looking at?
So loan to value is the percentage of your loan amount relative to your home value. So a lot of people talk about it 20% down. So in mortgage terms, that's an 80% loan to value or LTV. So it's a big factor in terms of whether or not you have to pay mortgage insurance, whether or not you have different rate options available to you. The lower your loan to value, the better generally in terms of your refinance, and certainly the avoidance of PMI. So it's a calculation, it's a ratio of your loan amount relative to your home value, which is determined by your appraisal, which is part of that cost structure.
Gotcha. And what is amortization? I mean, it's not an easy word to say or spell, but what are we talking about when we say amortization?
Amortization is the way the payment is calculated on a mortgage. So your loan is amortized over 30 years or 15 years or 20 years. It's a calculation that basically, when you talked earlier about front-loading interest and stuff like that, in order to keep a payment the same over the term of the loan, they factor in how much interest you pay, how much principal you pay over that term. So the amortization schedule, the amortization payment is how your payment is derived and what your principal and interest spread is with each monthly payment that you make. And we have a whole amortization list of your loan once you get it that you can look at and see what your spread is from principal and interest. But amortization is how the payment is calculated.
Gotcha. Term interest. What is term interest?
So the interest of the loan over the term of the loan or the life of the loan. Your term is how many years? So 10, 15, 20, 30 years, that's the term. And then the interest is the amount of interest that's accumulated over that term of the loan. So a good calculation to have when looking at that overall cost savings. The monthly payment's important, but term interest is as important, if not more important, in terms of the cost. So like you mentioned before, from 5 years into my loan, if I go back to a 30, great, my payment's going down $400 a month, but it might be costing you an extra $10,000 in interest over the life of the loan by backing up those 5 years. So term interest is a big factor to consider when looking at the refinance as well.
And I'll try to answer loan estimate because you've already referenced it a bunch of times. Loan estimate is what you'll get from your mortgage loan officer when you're talking about what are the costs for the proposed loan that we're doing, whether it be a new purchase loan, or in our case here, we're talking about refinances, which just gives you a breakdown of the fees and the costs that you can make a better sense of the decision. So you know whether or not the refinance is worth it for you.
Yep, exactly. Yeah, you definitely want to press whoever you're talking to make sure that you're getting a loan estimate so you can get an itemized, detailed report of the costs associated with that rate that you're being promised. It's important. It's an important piece to have.
Awesome. So that we kind of went through our slides here. You've got a couple scenarios that we'll go through to take a look at how to implement some of these factors when looking at a refinance decision. So I'm going to stop my screen share, and there we are. And if you want to go ahead and share your screen with your spreadsheets, we'll take a look at it.
It says the host is disabled participants screen sharing. So
wow, that's there we go. All right, there we go.
Our first.
That's our tech team here.
Yep. All right, let me know when you can see my screen here.
I can see your screen.
Okay. So what we have here is just a basic scenario, kind of what we were talking about a little bit before. This person bought their home 5 years ago. They paid $375, had a loan of $300,000, which has now been paid down to $272,000. So that's right here. So this is their current mortgage setup. They have $272,000 on their loan. The rate is 4.375. Their current loan term is 30 years. Principal and interest payment, homeowners insurance, taxes, those are all going into that total payment of a little over $2,000 a month, almost $2,100 a month. So, and the other factor that I put in here is how much interest they have left on that loan if they were just to continue to pay the minimum payments for the rest of the term of the loan. So this person has $174,000 of interest left on their loan. So this is what I usually send to my customers, when they're considering multiple options in terms of types of loans. 30-year, 20-year, 15-year fixed are the most common loans that we talk about. So I put these in the spreadsheet to kind of give people an idea of what those costs are going to look like, what the payment reductions are going to look like. So the 30-year fixed today, roughly 3.125 on a refinance. This is for somebody with good credit. This is somebody who has 20% equity or more in the home. That's the first option, is the 30-year. Second option I did is the 20-year, and then the third option is the 15-year. So you can see that the payments will go up in each case because we're shortening the term of the loan, and that brings us down to the bottom part here where you've got your estimated monthly savings compared to the current monthly payment, or in the case of the 20 and the 15-year loan, how much your payment is going up to shorten the term. Below here is the costs of the loan expressed in just one number. Like I would give you a loan estimate to break all these things down, but for the purposes of just looking at the estimates and how they affect your monthly payment or your closing costs, I just express them here as a total sum number. Excuse me. That's where you get that closing cost recovery, that break-even number. So in this case, this person saves just under $200 a month by going to a 30-year fixed. So they're going back to a 30-year from 25 years left. So he's saving just under $200 a month. The costs are $4,600. The break even on that is just under 2 years, which is great. That means as long as this person's going to be in the home for at least 2 years, they're going to be saving $200 a month basically after the first 2 years, and not relative to the fees associated with it. So this brings us to the term interest savings. So even though we're backing up 5 years, the whole interest cost for the new 30-year loan is $147,000. That's $22,000 less than what they have left, even when factoring in the costs. So this is 174 minus 147 minus that 4,600 gives us a total term savings on the loan of $22,000 in interest costs. So not only have we broken even in 2 years, but we're going to save $20,000 if we paid the new loan off in 30 years, even though we have 25 years left on our existing loan. Does that make sense?
That makes a lot of sense. And so I can just kind of extrapolate that to the following columns as well. So the 20-year fixed, if I look at that bottom term interest savings, we're saving 80 grand, almost 60 grand more.
Yeah.
And we've got 10 more years with no mortgage payment.
Right.
Because it's a 20-year, and then the same thing with the 15-year, dropping almost $90,000 more worth of interest. So this is really helpful. Now, a question I have, right? So if we look at this, just that 30-year column, someone says, "Oh yeah, I'm going to do it." I recap my costs in 24 months, right?
Mm-hmm.
So it's going to take me 2 years to recap my to recoup my costs. But what if I'm thinking I might move next year?
Yeah, and that's where this doesn't make any sense now, right? Because your break even is 12 years, 24 months. If you're leaving in 12 months, you've now paid 12 months worth of costs that you're not going to recoup. So even though you're saving $200 a month, you're not going to recoup those costs that you either rolled into your loan or paid out of your pocket. And that's
even though I saved more than one interest on my mortgage rate.
Yeah,
1%.
exactly.
Yeah.
Right. In this case, it's more than 1%. So in this case, yeah, you get the 1% savings, which most people are looking for, just not knowing the whole scope of the break-even calculation. But if you're leaving in a year, you've left yourself a year short of breaking even on that cost, even though you're dropping a huge amount in your interest rate.
That's great. No, this screen is very helpful. And I know a lot of times people look at their loan statements and go, "Oh, my payment's $1,894," or let's say their current mortgage $2,087, but actually the mortgage payment itself, the principal and interest, is only $1,358. They're adding in those other escrow costs that they're paying for property taxes and homeowners insurance. So you want to make sure you're comparing the actual principal and interest payments to each other, as opposed to knowing if they've got all your other monthly expenses factored in there.
Yeah, and I just realized I made a mistake on this spreadsheet, because this loan amount at 272 should actually be 300,000, because that was their original loan amount, right? So
right.
Where their new loan is 272, because that's what's left on the loan. So the savings is even significantly more because the original loan is 300. That's what their current payment is based on. So
Gotcha.
The 272 would be their current loan, because 5 years into the loan, had paid down about $28,000 in principal.
Right.
So the savings is even more. And that really leads us into that 20-year fixed, right? Because this is where you get the really biggest bang for your buck, in terms of, especially, the goal of having to pay off your debt sooner. You can now flip this into a 20-year, pay roughly $10 a month more than what you're paying now. But look at that interest savings. I mean, $80,000 in interest savings just by switching from a 30-year to a 20-year at a significantly savings in the interest rate. I mean, it's that works itself into no-brainer territory, in my opinion.
That's awesome. Yeah, that's a great scenario. I was hoping there would be maybe some live scenarios. Don't know that we have those, but we're available if people do want to reach out to us to talk to us about their specific scenario. Do you have another scenario or a situation that maybe we could, even if it's
Yeah, so what I did was basically just drill down on the option of, so this is what we have, right? This is the three choices of the 30, the 20, and the 15. So let's say the person's like, yeah, that 20-year makes a ton of sense, because I can basically, my payment's comfortable for me right now. I like the idea of not really changing my cash flow too much and saving a boatload of money over the next 20 years. So that's great. So now we look at, okay, what else can we do with that 20-year to maybe make it even more attractive in terms of the long haul? So if this person's going to be in their home, until they pay off the loan, or at least for, let's say, 10 years plus, then we start talking about, well, does it make sense to maybe get that rate even lower by incorporating some of those discount points that we spoke about before? So in this particular scenario, here's that first scenario where our costs are the same, or just the 0-point rate, right? So if you look at this one, this column from the original is the same as this column here. So this is our starting point. This is our 0-point rate, 2.99% on a 20-year loan. Costs are the same. What you're not getting a real clear indication on here is the recovery on the monthly payment, because of you're not reducing your monthly payment, you're reducing your term interest. So this can kind of be ignored a little bit. But what we're doing here is You can pay a little bit extra to get to 2.875. Your costs go from $4,600 to $5,900. You get a little bit of incremental savings from going from $80,000 in interest savings to $82,000 in interest savings. And now you're saving a little bit of money monthly. Where I would probably look towards is this last column here, where you can get 2.625, pay, $3,000 more. It's not cheap. You're paying almost a full point, a little over a point to get the rate down to 2.625. But you're seeing a monthly payment drop of $40 a month. And you're also looking at an interest savings net of fees of $88,000. So now you're talking about a rate that's 2.6%, that if it ever goes lower than that, we're in real trouble economic-wise. So if you're in that home, you're never probably going to refinance out of that rate. You're going to have that great rate for 20 years. You're going to save a little monthly, and you're going to realize probably the biggest return in your interest savings over the life of that loan. So a lot of people don't want to have the conversation about points, but if you look at them and use them effectively, even though the cost is more, you really justify that cost by staying in that loan for a long time. Which, if that's not your goal, this doesn't make sense. But if your goal is to stay in the home for a long time, this starts to make more sense. And that goes back to that conversation of how long are you going to be in that home.
Well, that helps a lot. And I think, one thing I'm getting out of it, which some of it I known, but just going through it again is always a great refresher. But for people that don't look at this all day, I think it does reinforce the idea that there's a lot of factors, right? And there's a lot of different options and scenarios. And so having a situation where, you're able to sit down with someone that, will take the time to explain all this to you, to go over those options and really to determine, from my viewpoint, what I do is like, what are your long-term goals here? And how does kind of working on a mortgage refinance, like what ground are we going to be able to gain by, doing something new with the mortgage, whether it be, savings on long-term just interest costs, changing something up with the monthly payment so we can get after maybe some other higher interest rate debt that we're just trying to eliminate, or just, refinancing to a shorter term to really just go after this, save the interest expense, and then, be without a mortgage and kind of have our cash flow open up so we can go after some of those other goals.
Right.
So
you brought up a good point too. Sorry to interrupt. Is that in some cases the 20-year might make a lot of sense, but like you said, if you got other debt that's high interest debt, a refinance opens up cash flow to pay that off quicker, and that's almost, if not more important than the mortgage debt, right? Is getting rid of that other debt that might be saddling you. And if you can refinance and save a couple of $100 a month and redirect that towards that high interest debt that you're not getting any benefit from them, that's a huge benefit that we really didn't even touch on.
And we didn't get into this today. Maybe it's going to be a different lunch and learn as we kind of wrap up here. But, the idea too that even if the interest savings aren't there, there's still the opportunity to make principal reductions on your mortgage,
Yep.
Avoid the refinance costs. But you can, there's ways that we could sit down with you to calculate, how would we have to pay this so that it is gone in 15 years or it is gone in 10 years or whatever, without bringing on the cost of a mortgage refinance, which again, it kind of just one of those things that would fit into what's the long-term strategy here? What is our goal? What else is going on in our life, not being in just a vacuum, solely just looking at the mortgage, but what's the broader picture look like, and how can we kind of help you develop a plan to get there? So Griffin, I want to thank you for your time today. This was good. It, we'll be able to share this recording and put it out there so people can use it as a tool with some resources. And once again, I'll just throw up our information from anyone that might want to. Well, I'll go back to the top here. If anyone would want to contact us for. Let me share my screen here. To help walk through their situation in particular, because like we said, everyone's situation is a little bit different, and we want to make sure if you've got a scenario that you think maybe we didn't cover today, we'd be able to talk to you in greater detail to help you kind of work your numbers and see what whether or not the refinance makes sense for you and how it fits into your overall plan, and we're happy to do that. It's what we do every day, And again, thank you, Griffin, for joining us today.
Thank you,
And
Paul.
yeah, stay if you join our email me. You can I'll put you on a mailing list. So when we have events like this or lunch and learns, and something like this is free, but it's in one sense invaluable. You'll be able to join and take some takeaways. I know I'll get Griffin on here at some point again, and we'll maybe talk about how to prepare for a first home purchase or any kind of home purchase. So as you enter that part of life, whether it's your first home or second home or third home, we can better equip you so that you're knowledgeable and can make good financial decisions for yourself. So